Hello and welcome to another free webinar from Option Hotline. I appreciate everybody taking the time out of their day to come and observe this great webinar from Dr. Duke. We'll get started in just a moment here. As a reminder, go to optionhotline.com/webinars to see all of our prior webinar content, as well as sign up for our next webinar, which will be next week, hosted by me, Keith Harwood. Before we get started, I always have to give these webinar disclaimers. Please take a moment to read through this, and then I will hand the reins over to Dr. Duke, and you can get into the good content. All right, Dr. Duke, are you ready to take the reins here? I think I have you muted at the moment, but I can hand over the reins as soon as you're ready.
Am I still muted?
No, you're all good now. When you're ready, feel free to take over the screen and you can get into the presentation. Thanks again for presenting today.
Okay, thank you. Get my slides up here. And I think we're ready to go.
Absolutely.
Okay.
Perfectly.
Thank you to everyone. Thank you, Keith. Thank you for inviting me, and thank the rest of you for being here. I want to talk about the option Greeks today. Sometimes these seem a little esoteric, and what I hope to do is give you a basic definition of the Greeks and show you some examples of how I use some of the Greeks in my trading. And so let's get on with that. If we have any option position, we have risk coming at us from three different areas. The price of the stock or the index. Now that's the one that's kind of obvious. We always watch that. The one that surprises new option traders is volatility. Very often they watch their position change in value and they can't figure out why, because the stock either moved the other way or didn't move at all. And then finally, the passage of time. Again, a new option trader is used to buying stock where if the stock just goes sideways, he's neutral. But that's not the case when you buy a call and think you're bullish, because if it just goes sideways, time starts to erode your position. Now, what we do with the Greeks is it helps us to know where is our risk coming from. If we're looking at, let's say we're looking at Apple, we're bullish on Apple, and we've got 2 or 3 different trades that we're thinking about that would profit from Apple going higher. One thing you can do is compare the Greeks on those 3 trades and get an idea of which one fits the current environment. For example, if volatility is currently going up or going down, etc. Also, once you've decided on your position and have it going, checking the Greeks periodically is kind of like the dashboard in your car. You know if your risk is shifting and now you have more risk from another area, or if the risk from price is growing to a point where you want to stop it out. Now, the Black-Scholes equation is the equation that we can use to calculate the theoretical value of an option given various inputs like the price of the stock, the historical volatility of the stock, the strike price of the option, timed expiration, interest rates, etc. Now, it's a complicated equation, but it's worth pointing out that in every term of this equation, the probability distribution or the Gaussian distribution is there in every term. So options are basically a probability games. Always keep that in mind. Now, delta is the first derivative of the Black-Scholes equation. If you ever took calculus, you'll recall that when we have an equation that has several variables, one way to better analyze it is to take a derivative, which is in effect what you're doing is you're holding the price or holding the values of all of those variables constant except one, and then varying it to see what its effect is on the output of the equation. In this case, we're taking the first derivative of the Black-Scholes equation with respect to the stock price, and we're seeing what the effect is of the stock price moving up or down on the option price. And so delta tells you how many cents or dollars the option price is going to change for $1 change in the stock price. Gamma is a little different. Gamma is the second derivative. So we take a second derivative, and that tells us how much the delta value is going to change with the next dollar change in the stock price. In other words, it's giving you an idea if you're in a particularly sensitive area of the risk reward curve, where that next dollar change makes you a lot more money or perhaps loses you a lot more money. Vega is the option Greek that determines the change in the option price if volatility goes up or down. Theta is the time decay. The theta, the delta Greek or the option Greeks, that's theta, simply tells you how much is your option price going to drop or decay with the passage of 1 day of time. So thetas are always negative. Only time you have positive theta is when you have an option position where you're selling options or you're selling a predominant number of options. Now, one of the things I didn't mention there that was on that slide is that the very fact that we're holding those other variables constant is unrealistic, of course, because if I'm looking at delta and saying, well, the next dollar increase in the stock price, I'm going to make $100. And then it does go up $1, and I look at it and say, well, I made $120. What's going on here? Well, it means one of those other variables changed as well. Implied volatility went up, perhaps, something like that. So this is an approximation under the best of terms when you look at real life. Generally speaking, if you're buying options with larger delta, it means that you're getting closer to $1 per dollar move in your option price. Because normally delta is expressed as a percentage or a decimal. In other words, somebody will say it's a delta of 40. What they really mean is it's 0.40. In other words, if the stock price goes up by $1, that option price is going to go up by 40 cents, $0.4. And sometimes you'll see it expressed as a percentage, 40%. So that's a little confusing, but just remember to accept it either as it's 44, 0.44, or 44%. It's always the same. Now, if we buy an option that's deeper in the money, obviously it's going to move closer to the value of the stock. It's going to have more leverage, if you will. If you buy it out of the money, that's a cheaper option because there's no intrinsic value in the option. So that means that if that prediction that the price is going up occurs, you have a much larger percentage gain because you paid less for the option to start with. But on the other hand, if it goes the other way, the losses mount much faster because you don't have any intrinsic value in the option. Now, finally, one of the things that traders use as an approximation is that the option delta is approximately the probability of that option expiring with value. Now, I emphasize this is an approximation. There's no mathematical linkage here that makes it precise. But as you'll see in a moment, it's pretty good approximation. And everybody uses it that way. Gamma, on the other hand, as I said before, it measures the change in delta with the next dollar change in the stock price. So larger gamma tells you that you're on a steep portion of that risk reward curve. Think of delta as the speed of this option price change, and gamma is the acceleration. So gamma, the large gamma is telling you that the next dollar move either way is going to make a big difference in the P&L of your position. And that's why a lot of people tell you close your option position before the last week before expiration, because gamma is larger at the money and it gets larger as we get close to expiration. Here's a risk reward curve to illustrate that. On the left, you'll see we have profit above the zero line here, losses below. And on the bottom, we've got the different prices of the S&P 500 index. Now notice each of these price bars down here, $90 apart. So this represents an increase of $90. Notice the difference in the P&L. We're going from a loss that's close to $2,000 to nearly break even with that $90 change. But notice the difference here. Here's another $90 change. It almost makes no difference. It's close to break even either way. So this is showing you how gamma is larger here because our sensitivity to the next dollar change is greater than it is here. Also notice these black lines right here. This black line is the profit and loss for this position at expiration. Red is where we are today. And then we divide the time in thirds, the time to expiration. So blue is a third of the way in, green is 2/3 of the way. Notice if we were to do the same experiment based on the green line, the change is much greater than it was before. In fact, here, whereas it just kind of went flat to down a little, it actually goes up. And that's an important point. As you get closer to expiration, gamma is getting larger. So gamma is telling you that you're in a more sensitive place. So gamma is a very powerful view of your risk. Vega is the option Greek that gives us the change in the option price due to implied volatility increasing by 1 percentage point. Now, this is the only option Greek that's not represented by an option or by a Greek letter. I mean, Vega is not a real Greek letter. Now, if you read some academic literature out of a business school or something like that dealing with options, they will use kappa for volatility sensitivity. I have a good friend that was working on the exchange as a market maker way back in 1973 when the options first started being traded in Chicago. And he has no idea where Vega came from. Somebody just thought that made sense because it started with a V, and so they made up this term Vega. But regardless, point is Vega represents the risk by implied volatility changing. Now, each of your option positions differ in their sensitivity to volatility. Some option positions are notoriously sensitive. For example, a calendar spread. If the implied volatility goes up while you're in a calendar spread, generally speaking, you increase your probability of success, of probability of greater value, but you also increase the break-even range. Some other positions aren't as sensitive. So Vega is telling you which of your positions is more sensitive. And depending on where you are, if you think that the current volatility of this particular option chain is high, well, then it's more likely to go down in the future. So you don't want to have a position that has a large Vega sensitivity because it'll drag your P&L down. Theta. This is the option Greek that talks about time decay. I've put a curve up here that shows you how this time decay works. In other words, way out in time, if you had a leaps option, for example, with 2 years, it'll be almost linear, very flat. But as you see, when you get down to about 30 days and 15 days, it becomes more of an exponential curve. It's losing more each day. Loses $1 one day, $1.25 the next, and so forth. So time decay is an important factor because if I own an option and the price of the underlying stock doesn't change, I'm losing money. My option is getting cheaper each day. Now, if I've sold the option, I'm on the opposite side of that, which is why people like to sell options very often. Now, let's think a little bit about delta from how we would use it in the real world, so to speak. First of all, as position delta, if you calculate the delta for a position, for how many options or multiple options, or even you bought some and sold some, whatever, you can calculate delta for that entire position. Now, we'll go into that right now, but you can find out how to do that very easily. Equivalently, you'll end up with a position delta that shows you how strongly bullish or bearish this position is. The larger the positive delta is, the more bullish it is. Now, if you remember the old Roadrunner cartoons with the Wile E. Coyote, let's say he bought 5 Acme calls because he was always doing business with Acme, buying his latest rocket launcher or whatever. Well, the position delta is 205. Well, 205 shares of delta would cost over $30,000. Now, the question here, and the reason this becomes relevant, is if you have a position that has a delta of 205, are you comfortable having that much risk in effect? Because think about the risk if you had 31,000 invested. So that's one way to look at delta, and it helps you think about your risk. The other thing you can do is, let's say we put on an iron condor with SPX, and we start out with a delta that's very small, a so-called delta neutral position. It doesn't make much difference whether it moves up or down. I'm not going to change my P&L very much. But let's say over time, I've been in this trade for a couple of weeks. The market is continuing to go higher. My delta is moved to a negative 125. That means if SPX goes up $10 tomorrow, my P&L is going to be down by $1,250. And so that's how you can look at the delta for your position and get a feeling for whether I'm getting into a place where I'm not too comfortable with this. Similar idea is to look at the delta for your entire portfolio and then imagine some kind of Fed announcement or some other risk that you're anticipating. Now, market makers always watch delta of their entire portfolio of options because that tells them how much risk they have. If tomorrow morning, let's say they're making a market in Google, if Google opens up, spikes up tomorrow morning by $50, $100, they don't want to have a huge loss or have a large gain. They want to have their portfolio delta close to zero. Now, it may not be real close to zero. It depends on how much risk they're willing to take. But the point is they're watching that carefully because what they're trying to do is make money on selling an option at this price and buying it at this price. It's just that simple. So they're making small amounts of money, roughly the spread. So they can't afford to have a big loss based on the movement of the price or the price of the stock. You can do the same thing by watching the delta of your portfolio. As I mentioned earlier, delta is an approximation, a good approximation of the probability of the option expiring with value. Now, this is an older example, but it's still relevant. You could do it today. Apple was trading at 194 in April of 19. The 150 put had a delta of 2. I went through and calculated the probability of that option expiring with value is 2.6%. So it's always close. Now, what this means, delta of 2 means I've got a 2% chance of this $150 put having value. In other words, Apple would have to drop a lot. On the other hand, there's a 98% probability of that option expiring worthless. So if you sold that option, you've got roughly a 97 to 98%. 97.4 would be precisely correct. But if we were using just the delta, we said we have a 98% probability of success here. And that's close enough for government work, as they say. Now, I can also use that delta of the short option to position a spread. Because again, if you're thinking about it and you're saying, I really want to trade where I've got a pretty high probability of success. And so let's say you're thinking that I really want to be about 1 standard deviation out of the money. Well, 1 standard deviation is about an 85% probability, closer about 84%. But again, that's close. That would mean I'm looking for a delta of about 15. So I could run through the option chain and sell the options, the call up above and the put down below at deltas around 15. And I would be setting up a position that was roughly 85%, had roughly an 85% probability of expiring worthless or successful. The other thing I can do in this same example is if I set them up with delta at 15, maybe I decide that I watch the delta of my short options. And if either one, the short call or the short put, gets to 35, I close out that side of the trade. Because in effect, what it's telling me is my probability of success has now declined to 65%. So using delta as your trigger to adjust or to close is not a bad way to handle it. This shows a current example. Back a couple of weeks ago, Apple was trading about 144. And we could look through this chain and decide which put we want to sell. Well, if you're looking for a pretty high probability trade, you might focus on this one, where it's roughly an 8% probability of it being in the money, or a 92% probability of success. And so you would sell this for 52 bucks. And so you gain about 0.4% in 37 days. And if you felt more aggressive, you might sell it at 135 put. Now, what about gamma risk? Where you see gamma being high, it shows you, like in this case, it shows you why a monthly option is actually less risky than a weekly option in general. This is an example, and it goes back a few years, but it's an example of the 365 weekly option to the monthly option, 4 days versus 46. Delta was close, not much difference there, but look at the difference in gamma. Gamma was 3 times as large for the weekly option. And also look at theta. Theta was $60 versus 24. And you say, well, that's a lot larger. Well, it's even worse than that because the weekly option didn't cost near as much. 10% of the value lost in 1 day. 10% of the value lost in 1 day. So if this thing doesn't move the way you want, you're in trouble. It gets ugly in a hurry, compared to 1% of the value decaying in 1 day. So this is where you look for gamma being small. And if you see gamma increasing, it's telling you, it's warning you that you're getting onto a more sensitive part of that risk reward curve. What about Vega risk? I think I mentioned earlier that a calendar spread has a lot of sensitivity to volatility. Now, let's say I buy a calendar spread right at the money. Let's say Apple's trading at 150. I buy the option farther out, like say November expiration at 150, buy a call, and then I sell this next week's option, like November 5th, I sell that 150 call as well. That is a net debit. Now, as time goes on, if volatility increases by, let's say, 1 point, well, if the volatility increases on the option I've sold, I'm losing money there because it's got more expensive, and I sold it at a lower value. So I would have to pay more to buy it back and close it. But the long option farther out in time most likely has increased in value with that same change in volatility. But the key is that Vega gets larger with time. So that means the change in dollar value for that option that's farther out in time would likely be larger than the change in dollar value for the option I sold in the next week. And that's the power of the calendar spread. But it's power that goes both ways. Because the same thing in reverse would happen if volatility declines. So that's why when you put on a calendar spread, you better know where the average at the money implied volatility is right now for that particular option and where it's been in the past. You know, every stock has a range of implied volatility for their options over time. If you're looking at Tesla, I don't know exactly what it is, but I would guess that the lowest it ever gets is probably 35, 40%. And it probably ranges up to 100%. But if you look at something like Procter & Gamble, it's going to be more like 9% to 12% or something like that. In any case, you want to know, are we toward the top of implied volatility historically right now? Well, in that case, it's more likely it's going to decline, and I don't want to put on a calendar spread. I need to find a strategy that would benefit from declining implied volatility, like selling an expensive option and buying it back later. So always know where implied volatility is compared to its history. So in summary, delta gives you your price risk. And using delta as an approximation for the probability of the option expiring with value is a very useful way to use that delta or that delta value. Gammas, on the other hand, what you want to look for there is gamma getting larger? If it's getting larger, I'm getting in a more sensitive area where I can have either bigger losses or larger gains, either way. Vega, of course, tells us know what the Vega risk is for your trade, and then know what's more likely. What do you think is more likely as the trend for volatility over the next few weeks? And then know, does that hurt or help you? Some positions that you can put on, volatility is relatively neutral. Some, like the calendar spread, it's a very powerful risk factor or a good factor for you. For example, if you put on a calendar spread, let's say the Apple example at 150, and Apple stayed at 150 and volatility went up, you'd make a lot of money. You'd also find that if volatility went up and the price of Apple went up as well, because after all, with a calendar spread, you have price limits as well. It can't go, stock price can't go too high or too low or you'll lose money. But the advantage of the calendar spread is as implied volatility goes higher, those break-evens actually move out. So your risk, according to the stock price, is much lower than the risk according to implied volatility for a calendar spread. And that's why you have to understand these Greeks, because they point out these areas of risk and how they differ from trade to trade or from time to time. Theta, of course, it's a classic trend in the sense that all of our options are decaying with time. So if I bought an option, I've got to get the move, whatever move I predicted better start happening. I don't have time to wait on it. On the other hand, if I sold an option, I'm just comfortable with passage of time. I love that idea. Selling options on Thursday before a 3-day weekend is fun. Time is on your side. On the other hand, owning long positions over a 3-day weekend, that may be a little disconcerting. The classic, in my experience, is President's Day weekend, because our markets are closed on that Monday, but the rest of the world trades on that Monday. So if you've got option positions going into that weekend on Friday, you're kind of at risk that something big happens over the weekend or on Monday, and Tuesday morning, there's a huge hit to your position. And of course, all of your income generating trades, they always have positive theta. And that's why they're banking on the passage of time for that income, whether you're talking about a covered call or selling in a naked put. So hopefully that gave you a little bit of a handle on the option Greeks and how you might be able to use them in a practical sense in your trading. Kevin, do we have any questions before we close it up?
Yeah, thank you so much, Dr. Duke. That was a great presentation. I'll remind everybody, if you have further questions, please throw them either in the chat window or the Q&A box of your Zoom window. I do have a couple that have already popped up here. First off, you mentioned President's Day. What do you think about Thanksgiving, knowing that that's more of a North American holiday?
Well, and first of all, sorry I called you Kevin. Keith.
Yeah, no worries.
I don't know, brain fart, I guess. Any kind of holiday like that is important from a time decay standpoint. I'm always aware of that. I try to be primarily focused on what I would call the typical income trade, where I've sold options or sold spreads, and I'm just benefiting from time decay. But I also recognize that any of my positions, like let's say I have a diagonal call spread on where I'm basically bullish on something. Well, I get a little bit nervous with those because I'm thinking, well, this is a long weekend, a lot could change. And you always kind of worry about war breaking out or who knows what. And so it's kind of a mixed bag. I tend to load up on the short options before long holidays, but I'm just the opposite with my long positions.
Absolutely, that makes a lot of sense. We do have a question asking if it's possible to have a replay of the webinar. Yes, we will be posting a replay back at the optionhotline.com/webinars link. I'll bring that back up here before we sign off. You should also get that via email along with some follow-up options here from Dr. Duke, who produces some great content. So the other question that I'm seeing as well now is, so you just mentioned the income trades being more of your style. So is there a specific Greek that you're most focused on when you make your trades?
Well, let's take for an example. I sell iron condors on the S&P 500 every month. And I typically do it starting at about 60, 70 days out. So I'm selling, say now I'd be selling for January or something like that. And in fact, right now I have November positions and December positions, but I'll probably be closing November pretty soon, and then I'll sell January. Okay. But with that, when I set up the trade, I pay attention to delta for setting up those, where I position those two spreads. And I'm typically targeting about delta 15, 18, somewhere in that neighborhood. And I do that because that way, from month to month, over time, I'm always positioning at essentially the same level of risk. Because one of the things that people forget about is they'll say, well, I'm going to do my condor, but I always do it $100 out of the money. Well, $100 out of the money, if volatility is low, is way out. $100 out of the money when volatility is high is maybe not so far out. And so that's why I focus on delta, because that takes that into account for you. It takes that risk into account of the volatility of the market. And so when I'm positioning that initially, I've got a delta for the entire position that's close to zero. It may be 10, maybe 5, whatever. I watch that closely over time because I'm watching two things: the position delta, because that tells me the next $1 or $10 move either way. It tells me how much my P&L is going to change for that position. I also watch the delta of my two short options, a short call and a short put, because again, that's telling me, am I getting to a point where I may want to close that side, roll those calls up or roll the puts down or something like that. And so that's how I manage those an iron condor type of income generating trade with the deltas.
Absolutely, makes a ton of sense to me, of course. So let me take over the screen share here because I want to make sure that everybody knows where to see the replay if you missed the beginning of it. Let's see here. Hopefully you can see here, optionhotline.com/webinars. This is where we've got our webinar calendar. Again, Dr. Duke, that was what you just watched today. I'm going to be presenting next week on options being relatively cheap, given where we're at overall in the fundamental world. So how do we try to leverage that? All the webinar replays that we've had will be posted on this site, including Dr. Duke's webinar today, and that should be up by tomorrow. Again, if you have any questions for Dr. Duke, you had his contact information up there. We will be sending more contact information. You can also contact him from our About page, and you can also review his bio and services. So one of the great services that Dr. Duke provides, among all of these others, is his trading group. You should certainly take a look at that trading group option here. It's $159 a month. We'll be definitely sending you some more information on this so that you understand the immense value that Dr. Duke can provide for you on a monthly basis, since, I mean, he's clearly got a wealth of knowledge and experience here in the markets, and you don't want to miss out on that. Any other questions that come up, feel free to email Dr. Duke via the contact information he posted, or support@optionhotline.com, and I'll get that question over to him. Thank you again, Dr. Duke. We look forward to having you again soon.
Thank you, Keith. It's my pleasure.
Have a great afternoon.
Thank you.